On today's On the Spot, we have Rich Ilczyszyn, Chief Market Strategist with iiTrader. We're going to be looking at gold's early year moves and more. Stay tuned. Rich, Happy New Year. Thanks for joining me today.
Always a pleasure. Happy New Year.
So Rich, interesting couple days to kick off the year. We have gold rising up quite significantly after testing a double bottom on the last day of trading in 2013. Now, is it time to bring out those welcome back $1,500, $16 gold banners?
Time out. It's a little too early for that. What I would consider this is a reallocation trade. A lot of our institutional clients delevered their long positions into the end of 2013 for the tax implications. In other words, they wanted to take the loss for 2013, and after the New Year's, they simply reallocated those positions. And it also coincides with the market having a great level at 1180, which is your support. So it was kind of a no-brainer to offset, take the tax implication, reallocate, get back in. And really, if you take a look at the last couple of years of performance, you get a pretty good pop after New Year's. And I think that, we're seeing some investors sniff around, putting a little gold on here at the lows of the year, just in case we get some inflation. And I think that's probably what this is.
Now the holiday season's over. Next week will be a return to regular volume trading. What do you see coming out of gold prices now that all the regular folks are going to be back at manning the desks?
Well, I would expect that obviously volume is going to pick up and we should get a direction. The beauty part of the first part of the year is we generally get allocations. Either they love it or they hate it, which will give us a direction. My bet is that the low is in for the month. In other words, I think you're going to see a bias to the upside. However, the upside, I think, is going to be somewhat limited. We have tons of resistance in both gold and silver, the 50-day, the 100-day, the 200-day. So the technical setup is still somewhat bearish until you get above those hurdles. And really, the only thing that's going to give the market above those hurdles is a hint of inflation. And if that happens, you're going to see all those institutional clients that are basically underweight, maybe 2% or less allocation, get back in the market, and that would give you the higher prices, the 15 to 16, 17 you were talking about.
In the past, obviously, the U.S. economy and its health has been a major plot point with gold and metals prices. What do you see? Is this going to be a trend that continues in 2014? Are we still going to look to gauge where gold and metals prices are going to go depending on the health of the U.S. economy?
Well, I would say yes, because the U.S. economy is 1 to 2 years ahead of the rest of the globe as far as this quasi-recovery. So it's the U.S. that's going to let us into this mess, right? And it's the U.S. that potentially leads us out of this mess. So really, we'll have to see how things go after the first quarter. We do have some hurdles in February, with the U.S. government, whatnot. We also have Yellen stepping in. So the market's got to get through all that. And by the way, we've got earnings starting just next week. So the volatility is going to pick up, the volume's going to pick up, and I think gold's a pretty good bet as long as we don't break the 1180.
Yeah, I'm glad you mentioned Janet Yellen. She's been a major talking point in 2013, obviously big talking point so far this year. There's a lot of uncertainty with what she's going to do, it seems, with analysts out there right now. What are your expectations for what may happen when Janet Yellen does eventually take over in March?
Well, she's forecast and she's telegraphed her move. She's going to be very easy, very cautious. However, I think the QE cycle is reaching an end, and obviously with the taper, that's ramping that up. But it's very tentative. So I think they go ahead cautiously. If anyone's going to be dovish, it's going to be Yellen, and I think the market's already factored that in. So what we're going to be watching certainly are the currencies, the dollar versus everything else. And the stimulus package in Japan and the recovery in the EU. So it's going to be those combinations that she's watching and potentially decreasing or adding to the quantitative easing.
All right, let's wrap up with your short-term outlook for the yellow metal. What do you see happening with gold in the first quarter of 2014?
Well, listen, I think ultimately the low is in for the first quarter. If we do break 1180, I'm wrong, the market goes lower. We're telling a lot of our institutional clients as well as physical gold holders, just in case, have a hedge below 1180. You could buy some cheap options, protect yourself. That's kind of the wild card if it does break down. And remember, last year, the first month was good for gold, and then it started drifting lower in February into March and April. So that's what you have to be cautious here about. But really, I think this could be a situation where gold kind of go sideways for a while. It could go sideways for a year until we get that inflation, until we get that catalyst to get investors off the sidelines, the institutional guys back in. We could be just sitting sideways. Really, if you take a look at gold in the last couple of years, we had about a $400 or $300 range. We broke $1,500. You take a $300 or $400 range to the downside, and we could be sideways. So about 1180 to maybe 1480 for the year.
Excellent. Great stuff, Rich. Thanks for joining me today.
Anytime. Let's do it again.
And thank you for watching. If you have any comments or questions, please don't hesitate to send them to newsfeedback@kitco.com, or you can find me on Twitter @Alex_Letourneau. Thanks for watching.